Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We'll be coming to you live from the 85th Annual STA Market Structure Conference. Joining for this segment is Richard Johnson. He's the Head of Market Structure Research over at Greenwich Associates. Richard, it's great to see you at STA. Let's talk about your favorite topic, the tick size pilot.
Yes.
What went wrong? All that good stuff. So let's kick it off with that. Did the demise of the tick size pilot, did it come as a surprise to anyone?
No,
what went wrong?
it doesn't. We've been, it was a 2-year pilot, and it officially ended last Friday. So it's over. We're back to the old tick regime. It wasn't a surprise. During the pilot, a lot of people were saying we should just discontinue it. But even the way it's set up was set up from the beginning. I think it was set up to fail. The main problem being is that it was an idea that came out of Congress and not out of the SEC, which is the agency that's supposed to be making the rules. And it's kind of forced down the throat of everyone in this industry. The rationale behind it was very suspect, in my opinion. I mean, just to remind people, it was put into the Jobs Act that the SEC had to investigate whether widening tick sizes could improve job creation. This was back in 2012 when we were still coming out of the financial crisis. But the idea was that wider ticks would increase market maker profits, which would in turn cause market makers to write more research on stocks, which would somehow lead to more companies coming public and increased capital formation. If that sounds kind of like a crazy idea, it is a crazy idea. It makes no sense. One of the main reasons being that market makers don't do research. We have Citadel and Virtue here, who are the biggest market makers.
Right. I don't recall seeing research out of them, so it kind of sounds like it was flawed from the start.
From the
you
beginning.
can see how it fits into the Jobs Act.
It's the jobs part. If there's more capital formation, then it will create jobs, I think.
Okay.
It's very tenuous, but yes.
Okay, so a couple questions here. What could have been done to make it a success? And with anything else that fails, we do learn something from it. So, what do we do going forward?
Yeah, let's not just criticize and talk about it. Let's learn from it. And I think it really can be the poster child for bad decision making. The first thing is it was, and in fairness to people in the industry who worked it was forced on them by Congress. Commissioner Piroir.
It's expensive too.
Said at the time, oh my God,
yeah.
$300 million is one estimate, $900 million in terms of the actual cost to investors buying and selling it across wider spreads. Yeah. But also massive infrastructure changes for the exchanges, for the brokers, market data providers, hugely expensive. So I think we need to make sure that rulemaking is done by the agencies who are tasked with rulemaking, like the SEC. I don't think that we're going to have that problem again, fortunately. We think we've learned our lesson here. But also there should be a cost-benefit analysis. There was no cost-benefit analysis done. And we've got the transaction fee pilot coming up. I think it's very important that we do a cost-benefit analysis on that as well.
Do you think that's better structured, or the plans are a little bit makes more sense versus what happened with the tick size pilot?
I think there's more industry support for it. But again, I think we need to know what we're trying to solve, what problem we're trying to solve, and how big is that problem, which we don't know, and how much is it going to cost to solve it. Because the problem for the transaction fee pilot is there's potentially broker routing conflict, and I'm sure there is to a certain extent, but how big is that problem? And if we take away rebates, how bad an effect on the liquidity provision is that going to have? Is that possibly going to make it even worse? So I think this needs to be a basic cost-benefit analysis.
And that seems to be the key theme this year and every year, whether it's STA, OIC, all the conferences that we cover, liquidity. It always comes back to that.
Yeah.
So, I mean, are you concerned that is going to impact it?
I think that is the concern. I mean, I was just listening just now to Chris McCann and Brett Redfern saying some interesting things. Like, we don't necessarily need rebates for stocks like Apple.
Right.
But I don't know if we have the right construct to implement that type of change where the rebates only apply to certain stocks. But I think it's an idea worth talking about.
Well, thank you very much for joining us at STA. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter.